Good morning, everyone, and welcome. I'm going to give just a moment for all the participants to cycle in, and then we'll get started. Okay. Hello again, everyone, and welcome to Entity Selection Series Part 2, Maximizing Income and Estate Planning Opportunities with the Right Entity Selection for Your Business. So this webinar is a follow-up to our Protecting Your Assets from Lawsuits with the Right Entity Selection for Your Business webinar that many of you attended last month, and we're glad you joined us again this morning. So before we get started, as usual, just a few quick housekeeping items for you. This webinar is being recorded, and you will receive the recording link emailed to you later today along with the slides, so be on the lookout for that in your inbox. This webinar is going to run for 50 minutes with 10 minutes Q&A at the end. So if you have a question for our presenters, go ahead and put it in the Q&A box, and that's located in your Zoom toolbar. To find your Zoom toolbar, just hover your mouse over the top or bottom of your screen, and the toolbar will pop right up, and look for the Q&A icon. All right, now I'd like to introduce our presenters. Dave Myers is a partner in LSL's tax department and focuses on compliance and planning in the areas of income and estate tax. He is a frequent author of LSL's tax-related client alerts, and along with LSL Tax Director Mark Zimmerman, was responsible for much of the firm's PPP-related guidance, including articles and webinars. Dave is passionate about helping clients increase their business and personal wealth. He enjoys helping clients with complex tax and estate planning issues and partnering them to take their business to the next level. Brent Honay has spent over 20 years in the investment industry helping families and business owners to properly plan their finances. He enjoys communicating complex subjects of estate planning and asset protection in a way that his clients can understand and appreciate so that they can go on to manage their lives with confidence and security. Brent strives to build lifelong relationships with his clients to ensure that their plans are up to date when they need to be implemented. All right, take it away, Dave and Brent.
Good morning, everybody. I'm glad that you made it here and for part 2, really, of the presentation of entity selection. And I just wanted to thank Harry and Brent for doing part 1. There was a reason why we did part 1 first, because it's part 1, but why did we do legal entity, the legal aspect as part 1? And it's really simple. When we're talking about income tax savings, property tax savings, you might be able to get a 50% tax break, or it's a fraction of a dollar. And if you're not structured properly legally, it's not just a fraction of a dollar. You could lose your whole business, which could be 1,000% or more return on your investment. So it's really important when you are considering legal business entities that the main consideration are the legal concerns. And I wanted to go over first a review of part 1, and I'll let Brent kind of chime in and correct me and keep me on the right track, because I'm repeating the great Harry Barth's trying to step into his shoes, which are way too big for me. The other thing I did, though, just in case you felt like shortchanged with Harry, because he had a total of 0 slides. I'm gonna just drown you in slides right now. So be prepared. We're not gonna go through and every little detail. I'm not gonna go into the weeds. We're gonna try to make this as profitable to you as possible. But but I'm gonna give you a lot of slides. Okay, so here we go. So Harry talked about basically the different types of legal entities. And in this list here on the slide deck, sole proprietor is the most simple, but least, it goes from least asset protection down to the best. So, you're sliding uphill, I guess, here on this. And sole proprietorship, no protection at all. Everything that the business does is going to be subject to any other act on the sole proprietorship. And then general partnership is basically two sole proprietors or three or whoever just joining together. So it's not even, it's probably even worse than a sole proprietorship. It's just in the same bucket because it's just no protection. Plus you're going to be liable not only for things that happen in your business and things that you do or your spouse does, but you're liable for everything your partner does too. So you have, it's exponentially worse. And then Harry talked about limited partnerships and then corporations, and then what we call the best is limited liability companies. And what I'm going to do, so Brent, any comments, or you want to fill in any of the?
Yeah, thanks, Dave. I think that's a great overview. A lot of times we're meeting with people for the first time and they're either sitting in a sole proprietorship or a general partnership, and I think explaining, how exposed we all are in that kind of a situation, and then to take it a step further, the folks that are in a corporation, and helping them understand if somebody's attacked from the outside and they get sued and lose that judgment, how a corporation doesn't protect very well at all from that kind of an event is very educational for most people. The one bullet point we have here as far as trust goes, just a quick note on that. A lot of folks we talk to, they're under the misperception that their family trust, their regular revocable trust, has some sort of magical protection to it. And it really doesn't. It doesn't have any protection at all. And so when we're talking about trust protection, there are different types of trusts that protect really well. It's just that family trust is not one of them. So.
Okay, yeah, and there was a question in Harry's presentation on can the trust be the owner of the business, and Harry pointed out that it's not advisable. The trust will be the owner of the entity. So maybe an illustration is your business is like a transportation company, and it's you take people around, and the legal entity is the vehicle that you transport people with. And a sole proprietorship is maybe like a motorcycle, and then a general partnership maybe is a motorcycle with a sidecar, which is not a good thing. And then as you go, you get down and you end up with a tank, right, with the limited liability company. Trusts typically are the title holders, right, to the car, or an individual is going to be the title holder to the car. So the trusts come in that relationship.
Yep. Yeah, absolutely. And I think that's a good way to put it, Dave. I think having that LLC set up in case somebody gets sued, if there's a lawsuit that arises, we want that for the legal protection. And then from an estate planning standpoint, we want the title holding, portion of that LLC to be held in trust. So we're passing things through the trust to the appropriate people when the time comes. Yep.
Okay. So how do these legal entities, now we're going to cross the street here and move into my area with taxes. How do they relate? Sole proprietorship is reported on Schedule C, which is a schedule that's on Form 1040. So the individual that owns it and runs it's reported right on Schedule C. General partnership is considered a partnership because you can't have two sole proprietors. It's just going to become a general partnership. That's reported on Form 1065. Same thing with limited partnerships and corporations. Now this is where it starts getting different from the legal side. A corporation is what the legal entity is. A C corporation is the default. So if you form a corporation legally, you're going to be a C corporation. What's C mean? It's subchapter C in the Internal Revenue Code. and then a subchapter S is where we get S corporation. If you don't do anything, you're going to be reporting that on Form 1120, a separate tax return, and S corporation, the election is needed, and that's going to go on Form 1120S, and it's a pass-through. So let me stop right here with just the term pass-through. What am I talking about? And a Schedule C, a Form 1040 is just going to be reported all the taxes on the 1040, and a C Corp is going to report all the taxes on 1120. But a pass-through is not going to be paying taxes. Well, you'll say, yeah, I'm paying tax in California. California has some entity pass-through level taxes, but in general, pass-through means pass-through. That entity will file a return, pass all its income out to the owner. And the question that comes up is, well, I'm not getting any distributions. I'm just plowing everything back into those entities, or and I'm not getting any distributions. It doesn't matter. It's passing through to you. Okay. Then the last one is an LLC. What tax return does an LLC go on? And Harry said, this is the Swiss Army knife of entities. And that's a great way of putting it. It has different personalities. You can structure it in multiple ways and use it as like a Swiss Army knife, whatever tool you want to use off of that. First off, if there's only one member in the LLC, it's considered a disregarded entity. Well, what's that mean? It's just going to be reported on the owner's tax return. So if the owner is an individual, it's going to go where? Schedule C on the tax return. If the owner, or Schedule E, if it's a rental property, to say. If there's more than one member, then you can make an election to be taxed as a partnership, C Corp, or S Corp. And I should clarify that the default, if you don't make any elections, the default is a partnership. But I wanted to highlight that once you have an LLC with more than one member, you have these choices. So partnership is Form 1065, C Corp, Form 1120, S Corp, again, Form 1120S. Partnerships and S Corps are pass-through entities, and C Corp is not, okay? And then we talked about this, Brent mentioned this, the trust is not used, the entity housing the business, but can be the owner of the entity. And a lot of times should be, right, Brent? I mean, the trust is a great way of owning. Now, we'll talk about some restrictions with an S corporation on that, but anyway, it's a great way to own the shares of a corporation or the membership interest of a LLC or the limited partnership interests of a partnership. Any comments, Brent, on this? Or
I think that's a great walkthrough there, Dave. Yeah, I'd say, our typical here when we're reviewing existing, entities that are out there that people bring in and say, hey, is this entity okay? Which is, we do a lot of that, where people will have a variety of ways that they got to where they're at today. And then they come see us and say, does this look like it's going to hold up? Or, worse, when they come in because something's going on already and they have an existing issue and they want to know if the entity that they have is okay. We're reviewing things. What we're looking for is we want to make sure, that if it's an LLC, is it an individual that's owning that LLC, or is it their family trust? Because if I'm looking at individuals and they're up in age, we don't want to inadvertently have that family go through a probate situation. So we would rather see the membership interests of that LLC assigned to the family trust, so we know where things are going if something happens to them, and it's covered through the trust. So yeah, I think that's a great little walkthrough there. And Swiss Army knife, that's exactly how we view it. We've got a variety of ways we can use that LLC, and so that's a common part of a lot of the planning that we do as LLC. So.
Okay, I'm gonna run through some real quickly pros and cons and each type of entity. And as I do, I'm not gonna go through, get down into the weeds of every single thing, but I wanna use this as a foundation to talk about, get some case studies and what's the best entity for you as you go. But the pros and cons will help form the foundation. So sole proprietorship, obviously the two pros are glaring, and they're simple, and you don't have to pay LSL to file a separate tax return, right? So it's cheap, simple. You might have to get a DBA and file some legal document, a little bit, but and then you might need to get a FEIN as federal employee ID number, and if you have employees, but you might not even need to do that if you don't. So that's the pros. Very simple, and that because they're so simple, they're very simple to attack, right? And it's the legal exposure is all the assets that are in the sole proprietorship are subject to attack if you do something that's not related to the business. They can just take it as yours, and if you do something in the business, it can explode out and go after you can be liable for the rest of your assets, not just your business assets. Con is self-employment tax. So anything that's that you make is subject to the self-employment tax rate, which is I think 15.3%. And then you're subject to the Medicare tax on income that's above certain levels. So and everything's taxed for that purpose. Okay, general partnerships. As we talked before, this is just a group of sole proprietors. Simple, but the pros are they're simple to form. You could do verbal agreements. Wouldn't recommend that at all. I mean, Brent would say don't do that, but you don't have to register these with the California Secretary of State. You can kind of get right into it. The biggest pro is now you're a partnership, and the pros in this case are more as compared to a corporation, I would say. You have the partnership tax law, which gives you special allocations, capital and income. You can structure it so you have different rights and different interests. And this pro is going to go towards the limited partnerships and LLC that's taxed as a partnership. So I wanted to kind of spend a little bit of time here, even though this is general partnership, but partnership tax law gives you can specially allocate the profit. Everything's subject to substantial economic effect rules, and you can't do things that don't make sense economically. And there's some complicated tax rules. But let's say you have like somebody that's contributing. You have two people. One's the money and one's the brains, or the muscle. The money and one the muscle, and then you can give preferential returns and like an interest rate kind of embedded inside, but for the money person. And then you can do special allocations for the service or the muscle partner, and be very creative and specially allocate things. And so that's a big pro, partnership tax laws. And the qualified business income deduction is what you would have a sole proprietorship, but with a partnership versus a C corporation in this case, you get this qualified if you're not a specified service activity. You generally are going to get a qualified business deduction, which is 20% of your income from that activity. And we'll talk about that later in terms of how that affects different rates. And then property tax law benefits and flexibility for estate planning and gifting. And Brent, you can touch on maybe you can touch on the property tax benefits on using a partnership. In this case, general partnership, limited partnership, or LLC taxed as a partnership. And in general, if you structure it right, you can avoid reassessment. There's also maybe you can just briefly talk about the Prop 19 workaround for this.
Yeah, we can spend a moment on it. I think what we see a lot is, particularly when we're talking about real estate here in California, a lot of folks are not up to date on the passing of Prop 19 that happened here for all of us in California. What used to be, where we could take properties that we had, held in the family for a long period of time that had appreciated. It was quite easy to, do a parent-child exclusion and pass things along to our kids when the time came or when the time comes. And that largely got restricted down with Prop 19. And so a lot of folks that have these legacy assets that they want to keep in the family, that they want to try to, keep the property taxes low. There is an exception that we will use called the Dell exception, that is really taking property that's owned, maybe by a family, and creating an LLC, contributing interests to that, waiting around a bit, and gifting inside of that LLC, gifting some of the membership interests inside of the LLC. It's a multi-LLC approach where we're doing some gifting, moving back out of that LLC, creating a new LLC to then do some more gifting, and ultimately we're trying to gift that property in the LLC and bypass the future reassessment. And so there's those sorts of situations that come up. And so we can, it's something that we do a fair amount of. And so it's something that we'd want to set up a special appointment with somebody who wants to learn more about that kind of an approach. But definitely, that's a hot topic these days, is keeping things in the family.
Very good. So, and then kind of flowing from that into flexibility for estate planning and gifting, it's partnerships, or limited partnerships, or LLCs taxed as partnerships are the king of estate planning. It's the entity that's the best, and there's multiple reasons for that. I would think there's in terms of discounts and gifting and rights and restrictions to what things that you can't do as much with a C corporation or S corporation. Even you just can't do different rights and bifurcate interest and restrictions and all that.
Mm-hmm.
And the other thing here too is that the treatment of liabilities, and there in estate planning, the treatment of liabilities is that another pro with a partnership versus an S corporation is you get basis for liabilities that you're deemed assuming, but on an S corporation you don't, unless it's your own money that you're putting in. For the other thing for estate tax planning and gifting is a thing called step up in basis. And so what happens if you have your business in a corporation, C or S, what asset and one of the spouses that say dies and it goes through the estate, and what assets going through the estate? Well, it's the stock interest, or it's the membership interest, or it's the general partnership interest, and that gets stepped. And with a C corporation or S corporation, now you have a very valuable stock certificate, but the asset, there's no way of getting benefit for a step up in basis to the inside assets. With a partnership, there's mechanisms for doing that. There's an election called 754, and you can step up the basis of the assets underneath and start getting increased amortization or depreciation deductions on that. So it's a partnership is the preferred vehicle for all those reasons. Okay. The cons for a general partnership are legal exposure for the business, and I talked about that earlier, and for the actions of your partner. So if you're you're Larry and your partner with Mo and Curly, Mo and Curly do something on their own outside of the business, now you're subject for all their issues. And so it's the general partnership is like a minefield. You have to file a separate tax return, and again, it's a partnership, so all partnerships or LLCs, taxes partnerships are subject to the self-employment tax on the income that you make. Okay. Limited partnerships. I'm not going to spend the time on this one because we talked about the partnership tax laws. It does provide some legal shield to limited partners, and it does have the qualified business income deduction. The cons are the general partner is somewhat exposed, and there's ways of mitigating it, but it's still it's more complicated form, and again, self-employment tax. Now, I don't see too many. Brent, do you do limit? You talked about the family limited partnerships, but I don't see anything. It seems like the LLC is which we're going to go to shortly is the preferred vehicle, and it's just there's not many reasons to have a limited partnership legally. That's fair to say?
We run into this situation occasionally where that's the direction that we go, but normally, it's preferable to have that LLC for asset protection purposes, and then have that, have the taxation be partnership taxation of that LLC. So they kind of get the best of both worlds, right? They get the protection of the LLC if the lawsuit rolls up, and they're not sitting in that position of total exposure. Like you said, if I'm Mo and I'm worried about what Curly's going to do, I don't want Curly's problems, taking me completely down. We want the LLC for that. From a partnership standpoint, for all the reasons you were talking about in the the previous slide, just for all of the tax planning purposes, to pass things along and gift inside of that that LLC, we can do that all day long as a partnership taxation. But we want the LLC being kind of the mothership, if you will, or the entity that's the legal entity of choice should we get sued. So I would agree with you.
Now on to C corporation. They're relatively easy. Corporations are easy to establish generally. Tax impacts are low because you're using section 351, which basically says it in general, it's not, you can contribute assets to a corporation, and There's no tax, it's tax-free. And so it's like very easy to get into, but on the other side, it's hard to get assets out once you're into it. And we'll talk about that. You have the legal protection of a corporation. And Harry talked about this, though, that's good. It's better than the general partnership before, obviously. But you need to beware of outside in attacks. I think you have inside outs when uh, an occurrence happens, somebody has a product liability issue in the business, and then they sue, and then so the shell is on a corporation from that going out, is it's going to protect the blast against the owners. But then what happens if one of the owners or a wife, I think Harry used the example of his wife, has something, and then there's an attack that can be made going outside in and attaching the corporation, and potentially as that one of the assets taking over ownership, forcing sale, and basically getting to your corporation. So that's the did I miss any? Is that right?
I think you're right on there, Dave. I think just to kind of hammer it home, that's kind of a big. We do a whole talk on the subject of being blindsided, right? And the blind side would be that scenario that you talked about. We think we're great in a corporation. It doesn't matter if it's a C corp or an S corp, but we hold our ownership in that business in stock. And when we do that, the example Harry used was his spouse, because we're sitting here in a community property state. If my spouse runs around and gets in a bad accident that a lot of people get hurt in, and there's a lawsuit that comes from that, and there's a judgment that's made, is my ownership in my company at risk, from that? And the answer, if I'm in a corporation, is yes, because it's an outside liability where somebody can literally seize my stock and liquidate the business. And that's really what we want to avoid at all costs. So it doesn't matter if it's me on the outside that's getting sued, my spouse, my kids that are driving my cars. If that lawsuit comes up through the family, that's the big negative of sitting in a corporation from our perspective, is we want to close off that blind spot, right? And we typically do that by reorganizing as an LLC.
Thank you. And the one highlight that kind of stands out on pros is right now C corporations are taxed for federal at a flat 21%. And what's the individual income tax maximum rate right now? 37%. And so there's a big push to say, well, let's be a C corporation because of that rate differential. And I'll point over on the con side, the whole concept of hard to get assets out, sale treatment. So if you're ever distributing any assets out of a C corporation, it's going to be treated as if you sold that to an outside party. And then so there's if you're trying to get low tax rate, it might end up biting you in the future. And double taxation, what that means is you have to pay the 21% tax, and then to get the money out, you have to pay the either capital gains or dividends tax, which is 23.8%. And so then if you they call it like an all-in rate for a federal all-in rate for a C corporation. If you're taxing the money at the C corp and then taxing it again, either as a capital gain or a dividend, it's 39, I think it's 39.6 or 8% is the all-in rate. And if you're a outside pass-through entity that's getting the QBI, the all-in rate would be 29.6%, I believe. I'm probably missing the 0.6 or whatever, but it's still if you have QBI and it's if you look at it from a double taxation, it might be a trap that you're falling into just to get the low rate. Pro on a C corporation, fringe benefits. It's considered the best vehicle to get deductibility for fringe benefits on the owners. You don't pay the self-employment tax. You're only paying payroll tax on any wages that the owner takes out. And there's no restrictions on stock ownership. This is kind of going into the next one, which is an S corporation, kind of the restrictions that you would have, and you don't have that. It's hard to get assets out. We talked about that, and not as flexible for estate planning. And then the side thing that on double taxation, the thing that kind of keeps you, that you're always running up against is if you don't want to get double taxed, then the urge is to take it out as compensation to get the earnings out. So you're not going to get that. And there's reasonable compensation rules, and if you're not taking it out, then you have accumulated earnings. So there's like a corridor you have to go in, and it kind of limits your ability to get the benefit from the low tax rates. It's forcing you to get into the double taxation side. S corporations. Remember, S corporations, corporation is the legal entity. S, you're filing an election. It's, again, as a corporation, it's easy to establish and fund. It's a pass-through entity, and so there's no double taxation. So now you're out of the double taxation, but now you're paying income on all or tax on all the income that it's flowing through to the owner. The other side is if you're having losses, to the extent that you have basis in those losses, and basis is established either by making capital contributions or loaning money directly from the owner to the S corporation, those losses would be able to be deducted on the owner's tax return and offset other income there. Qualified business income deduction and payroll taxes only on wages allocable. The net income the remaining income that's left and it's allocated to the owner is not subject to self-employment tax. That's a big pro, and I'll say yet. It's an area of concern. The IRS is going after, supposedly going after and this is a reasonable compensation issue on the other side. For C corporation, you're running against too much compensation. This is reasonable compensation too little, and there's been a tax. The IRS is kind of hoping Congress would, and for years, and it's been years and years, and so nothing's been done. So it's like, well, they'll never do anything, so let's just not pay ourselves wages. Well, there's negatives to that, but I'm not going to get into all of them. But it's just, you need to pay yourself reasonable compensation from the S corp. Pay the tax, the payroll taxes on it, and there'll probably be some law change. There's been the 3.8% tax is been they've been threatening to do that. It's been in different legislation that hasn't made it through, but to tax all income from S corporations. And then a legal protection of a corporation, and we talked about the outside in tax. The cons, these are big, so there's no special allocation. There's only one class of stock. There's limits on the deductibility of fringe benefits. The stock, the big thing is if you're going to have anybody that's a non-resident or a non-resident alien and certain types of trusts, you can't own stock in S corporation. So it really limits the ability. Plus, there's 100 shareholder limit. And there's certain types of qualified trusts. And if you want to, set up this for estate planning, there's qualified subchapter S trust elections you can do. And the question is, can a living trust own a S corporation? The answer is yes, because a living trust is treated as the shareholder. The individual shareholder is the owner. No basis for third-party debt. So if you're running loss and you're financing it through credit, bank, those losses get suspended. You don't get basis for that. And if you distribute any assets out, and this is something that people think, well, S corporations pass through, I can just put assets in and out. Unlike a partnership, if you distribute appreciated assets, it's treated as if it's sold to an outside third party. So there's a trigger on the gain. Okay. The LLC, we talked about this before, best legal protection, the Swiss Army knife thing, you can elect, make it a C corporation or S corporation. Single member is disregarded, no separate tax return, and the partnership rules, we've talked about that gives all the benefits of partnership if you are going to be taxed as a partnership. It's complex to set up, and I said subject to tax rules for entity selected. So some of the flexibility, you might give up some if you elect to be taxed as a C corporation. Just because you're an LLC and get the legal protection of it, you're still going to be subject to those rules. You can't flip around, and so you need to choose wisely. Okay, I'm going to take a detour really fast and talk about California AB 150 and other state SALT workarounds, and it's just real quick. This is only available to pass-through entities, and hence this is another benefit of being a pass-through entity versus a C corporation. Or a sole proprietorship does not qualify here in California. The basic rule of it is you're paying tax at 9.3% of the entity's income, and then you deduct that tax on the entity's tax return, and then the entity gives a credit that's passed through, that's claimed as a payment or a credit. California claims as a credit on the individual or trust return. And what are you doing? It's a game. It's a statutory lawful game to avoid the $10,000 SALT cap. So everybody on each return has only $10,000 in state and local tax, real estate taxes. So some people, their real estate tax uses the cap, so they get no deductibility on their income tax. And this is a way, if you have a pass-through entity, of getting full deduction on that. 39 states have enacted or proposed legislation out of 42. And why is 42? The other 9 don't have individual income taxes. So the holdouts are North Dakota, Delaware, and DC. And strategies, it would just be really quick. If you're a sole proprietorship or an LLC taxed as a sole proprietorship, maybe add a family member as a member and turn it into a partnership. Brent can help in terms of structuring and setting that up, but that would be one of the big workarounds. You just have to be aware too of when you form it and making sure that you pay. There's $1,000 that you have, if you didn't pay a tax last year, $1,000 by June 15th, which is 2 days from now, except we have the California disaster rules that are pushing everything through October 16th. Just as a reminder, I'll throw in a little bit of the disaster relief filing rules, but you need to pay in money and get that done, but also get your sole proprietor or LLC single member taxes, get it in as a partnership, and then you can get full workaround. All right, I'm starting or acquiring a new business. What entity should I utilize? And I'm going to say you need to play the long game from the beginning. The rules of thumb: don't focus on short-term tax savings over long-term considerations. So the two short-term are getting the low corporate 21% rate, and we talked about that, where the double taxation could end up obliterating your savings that you get, and then avoiding self-employment tax with the S corporation is a strategy that it's going to be subject to attack, and eventually, with the S corporation, you might be trapping assets inside and so forth. The best entity for estate planning is the partnership. We talked about that. Startups with losses use pass-through entities to pass out losses, and S corporations are limited to the shareholder basis and shareholder debt. So if you have losses, you might want the pass-through entity to pass those out, but beware on the basis limitation. Don't put real estate or appreciating asset into a corporation CRS. Why? Because if you want to get that out, you're going to have to pay be a recognition event, treated as if you sold that asset when you distribute it out to the shareholders. And don't use an S corporation for a highly leveraged business, again, because of the debt basis rules and limitations. Businesses that will always remain in the family with no plans to sell, maybe a C corporation organized as an LLC would be the way to go. But again, step up in basis rules, you want to consider that as you go. All right, scenarios. I'm running up against time, so I'm really rushing here, but startup service company, no family transition plans, but you plan to add key employees to ownership for succession and or sale to third party. What would be, and I think a perfect would be a partnership or LLC, tax as a partnership. Beware though that there's, in California, there's certain professions that you cannot use an LLC, that you can use an LLP, limited liability partnership. But use a partnership because you can start adding key employees and giving them not capital interest, but maybe profit and loss interest, which wouldn't be taxable to them when you grant them. So it's a way of adding employees and getting succession to them. Real estate investment, real estate, LLCs, and partnerships, always. And especially if you're going to be passing it to family members, it's a perfect way of gifting. And Brent talked about the property tax ramifications. And so use an LLC, a tax as a partnership. Retail store, including the real estate on which the store will operate. And then you just plan on operating it and selling it to a third party for your succession. In this case, I would set up 2 entities. And the real estate, again, always goes, you never want that in an S corporation or corporation. It goes into an LLC partnership, hold that separately. And it kind of brings up a point on, horizontal versus vertical liability. Horizontal is a vertical is the out in and in out exposure, But horizontal is if you have multiple businesses or multiple properties or pockets of wealth, you want to create vertical or horizontal exposure. So if something happens on one, then you're not going to get attacked on the other. And so maybe the retail store with an S corporation might be the way to go. If you're just going to be one owner, there's no plans to kind of give it or anything else to anybody else, and you're going to have a 7-year plan to sell, let's say, then maybe S corporation. But again, LLC tax as a partnership would be a very good choice. All right, I want to change my existing business to a new entity, considerations. So from a C to an S, requirements to make the change, you need to do that within 2.5 months after the beginning of your tax year. If you miss that, there's some relief, there's some things for that. But the biggest thing is if you have an existing business, you have to consider the built-in gains tax, which you have to take a snapshot of your business value, including inventory, all assets. And if you sell anything within 5 years after you make the election, you're going to have to pay the double tax basically on it. So there is considerations to doing that. If you don't plan on selling and you don't have a major inventory issue, then consider then that would be a good choice to change. C corporation to LLC tax as a partnership. If you do this, then it's going to be treated as if all assets were sold by the corporation. It's a big Armageddon tax event. So you might want to say if it's too high to climb, at least maybe changing to an LLC tax as a C corporation. Okay, and I was going to let Brent talk about that, but I think I'm running up against time. So let me go to the next one, and a sole proprietorship to an LLC. There's no ramification because it's still treated as going to be reported on Schedule C, or if the owner is a S corporation, let's say, it's going to be reported on the 1120S. But you might want to consider adding a spouse or child as a member to convert to a partnership to get the SALT workaround. Okay, and I think that's it. Brent, did you want to talk about the strategy of changing to an LLC tax as a C corp really quickly and before we go to questions?
Sure. Just quickly, I think a lot of these, this in particular, what we're trying to do is if I'm a corporation and I want to cut off that, from our legal perspective anyway, I want to cut off that outside in liability option where somebody can literally grab my business and shut me down. We want to take advantage of the LLC ownership for that purpose. And the simplest way to do that is through, doing that Plan F reorganization where we're not changing the taxation of that corporation, but we are changing the ownership entity to an LLC. And while we're at it, why not pick a better state than California, as Harry mentioned last time? And we have the freedom to do that. So we could reorganize that thing into Delaware, let's say, and register in California, and then keep our taxes the same. So that makes a lot of sense there. Same thing if I'm an S corporation. And then on your slide that was after this one, for sure, what we're saying around here is friends never let friends stay a sole proprietorship because we don't want an unlimited liability. So let's move that into an LLC. And the concern is always, what's my tax situation? Am I gonna have, major issues to deal with that way? And as you're pointing out here that you're not. And while we're at it, totally agree. Let's add some other members into that thing to beef up the security of that LLC. From our perspective, we love that. So, okay.
It's not only a positive for the SALT workaround, it's a additional liability protection.
You got it. And I don't recall how far Harry got into it, but we just don't want an LLC that's a single member in California that's highly pierceable, right? We want to have other members in there that are distinctly different. And so that fixes that problem.
All right, I think we're at questions.
Yes, we actually had several questions come in. Okay, first question. When is a single member LLC subject to self-employment tax and when is it not? Does it depend on the source of income?
So when is the LLC subject to self-employment tax and when is it not?
Correct. And then does it depend on the source of income, they said?
So an LLC taxed as a partnership, it would be, yeah, that's a good one. If you're there's different types of members. There's a managing member and like a non-managing member. There's a lot of disagreement or case law on it, and in general, you're going to be subject to self-employment tax if you are active in the business. You're a managing member, and it's type. You can be a managing member of a rental real estate activity. You're not going to be subject to self-employment because of the type of income. But if it's a regular business, and then it's based on your activity, your status, there's some probably more complicated rules that I don't want to get into now. But if you want, I can, you can talk to me directly. You have my contact information.
Okay, next question. When are LLCs in California subject to gross receipts tax?
Always. So the gross receipts tax is, I think, I don't have this in my brain memorized, but I think if you have over 250,000, it's like 900, and if it's over, I can't remember, but there's a great gradient. But I think if you don't have gross receipts over 250,000, then you're not subject to gross receipts. You're subject to the $800 minimum tax, or LLC tax, I should say. And all LLCs have to pay $800.
Okay, we have time for two more quick questions. The first, when I take my existing corp into an LLC for asset protection, what happens from a tax perspective?
Ooh, that's a good one. I'd say, just from to chime in here, we do that quite a bit here, and that's always an issue that comes up. And we're doing it for asset protection purposes. We want to, beef up the security. But the issue that comes up, if I'm doing that, let's say as a plan F reorganization, how big of a pain in the butt is that to me from a tax perspective, and what's that going to do to me? So Dave, what's the thought there?
So like my slide had, we talked about earlier, if I'm a LLC and I want to take my C corporation to an LLC, if I don't elect or check the box, we call it, to be a C corporation, and it's going from a C corporation to a partnership, then it's treated as if the C corporation liquidated, and when you do that, everything is taxable. So if you have 10 million of goodwill inside the C corporation, now that's going to be fully taxable. And then, so in terms of going your C corporation, you elect to be an LLC, or you go to an LLC electing to be a C corporation for tax purposes, then it's a change in name, and there would be no tax ramifications to that. I think California, you might have to file a separate, two short year returns, and California makes it a little more difficult. But in terms of the big problems that you have from going from a C corporation to a partnership, you don't have that.
Last quick question. If I want to change my entity, do I contact Dave or Brent?
Yes, that's the answer. So contact who do you look to as your most trusted business advisor, and you want to get the ball rolling, and talk to that person. And well, if you talk to me, then we would get you in contact with Brent right away, and we work as a team. So I think Brent would probably same advice.
Absolutely. It's a, all of, anytime you're dealing with things that are complex, where we're blending in the world of, how do I legally protect myself so that if I get sued, I don't lose, anything big, with the tax aspects of, okay, so while I'm maybe making a change here or considering making a change, what's that going to do to my tax situation? How can I make it better? How do I make sure it doesn't get worse? It's a team approach. We've always got to be that team. And what's great here is if you're a client of LSL, we're already a team if you're talking to me and the law firm here. And so we want to make sure that if we're making a big change to your entity legally, that we're not doing anything that's going to mess you up from a tax perspective. So it's always going to be a team approach is best.
All right. And with that, Dave, Brent, thank you so much for all your good stuff as usual. Just wanted to let all of you know as a reminder, we will be sending out the slides and a link to the recording later today. So be on the lookout for that in your inbox. And as always, we want to thank you so much for spending the hour with us. And until next time, take care and have a good day. Bye-bye.
Thank you.